This is a bill that is consistent with some of the Basel III, or one of the Basel III proposals. Members of this committee know that I haven't hesitated to criticize certain elements in the Basel III proposals, but this is one that makes complete sense. It simply says that if a bank with over $100 billion in capital has securities available for sale, that they need to mark to market the real value of those securities. It takes away the view of somebody saying, well, we paid $100 million for them, for these securities, and they're not worth that in the market, but somehow we'd like to think they were still worth what we paid for them. Marketable securities are worth what they're for sale for in the market. Now, we've worked with industry on this. They have asked for a gradual phase-in. This bill, consistent with the Basel III Endgame proposal, says that it becomes fully effective July 1, 2028. So we have a long phase-in for this change. As the only CPA on the committee, it's particularly important to me that what this bill does is it makes regulatory accounting mirror generally accepted accounting principles. Banks already use this system of accounting in their GAAP, or generally accepted accounting principle, financial statements, which are the ones they provide to their shareholders and which are the basis on which shareholders buy or sell their stock. And officers do or do not get bonuses, usually tied to stock price. It makes sense for the same accounting procedures to be used for the regulators, for the regulatory accounting principles. Now, the Bank Policy Institute, not known as a wildly progressive organization, but in fact, really the think tank for the banks, paid for by the banks, included addressing this issue in their listed recommendations on capital requirements in June 2023. The Federal Reserve of New York has done a study on this proposal, since it already applies to the largest banks. They concluded that banks are more likely to hedge their securities. What does that mean? That means if they invest in 10-year bonds, 30-year bonds, and there's a possibility that they will decline in value, and they're holding them in their available for sale account, which means it's available to meet the cash needs of the bank, that they will buy insurance against the possibility that those securities will decline. And that is exactly what they need to do. And the case study for us is Silicon Valley Bank. When we first heard that Silicon Valley Bank was in trouble, we thought, oh, maybe they lent money to small and medium-sized businesses and they chose the wrong ones. That's not what happened. They were doing fine on their business lending, but they had a large portfolio of long-term U.S. Treasuries that had declined nearly $2 billion in value, and that is why Silicon Valley Bank is no more. But they had insurance. They sold the insurance earlier that year. So this says that if a bank is going to hold these long-term bonds, and I know they're treasuries, in theory you don't lose money. You do lose money if you sell them before maturity, and these are securities that are being held for the purpose of being available for sale before sale for maturity. So let us, now that we've seen the example of Silicon Valley Bank, not only the effect on the bank, but the effect on our economy, let us say that we want a system that encourages banks, if they're going to hold these long-term bonds, to get insurance that the bonds may go down in value. or alternatively, they can invest in shorter-term treasuries. I yield back.
I rise in support of the amendment.
Gentleman is recognized for 5 minutes.
I rise in support of the amendment, which I think improves the bill. I'm concerned about the bill in general. I once again rise in support of capitalism, under which the government should not be choosing winners and losers. My concern is that this bill says, well, if you're innovative, then we treat you especially well, and if you're old-fashioned, we don't. And I just think that the market should decide, and that we should not be favoring through the regulatory process companies that want to do old things in new ways as opposed to the old companies that want to do old things in old ways. It may very well be that the innovative companies can offer products at lower cost, and maybe the market likes that. It may be that consumers want brick and mortar facilities that they can actually visit and see and talk to real humans, and the market will appreciate that. But the idea that the federal government should treat you better because you're higher tech or lower tech doesn't strike me. It strikes me as the federal government choosing winners and losers. I realize that some of our regulations are designed for smaller companies, and I think that it makes sense to have regulations designed for smaller financial institutions. We have a stake in preventing undue concentration. We have a stake in promoting competition. But I don't think we should be telling the market that we want a high-tech approach or a low-tech approach to financial services, and I yield back. I strike the last
Gentleman,
Yes.
Mr. Sherman is recognized for 5 minutes.
This is a payday loan. As a matter of fact, many payday loans are called payday advances. A rose by any other name or a payday loan by any other name smells the same. Now, we're told the question before us is not whether consumers will have access to this product, but whether we as a Congress are going to say it's not a payday loan. Now, went to a kind of good law school. I can talk about how many angels can dance on the head of a pin and how many bankers can dance on the head of a pin. But in substance, this is a payday loan. This is not selling a receivable. Now, why is that the substance? Because this is an advance on your paycheck. It means that when you get paid, you owe the money to the lender. But even for those who want to talk about, oh, you're selling a receivable, keep in mind most of these loans, you can let's say you get paid on the 15th of the month. You can borrow this money on the second day of the month and get it wired into your account on the third day of the month, and you haven't earned it till the 15th of the month. So this is not getting your money for carrying the sack of potatoes at the end of the day. This is getting 15 or 30 days of carrying potatoes paid in advance. Second, it's my understanding that employers don't have to cooperate with this. This is not assigning a receivable where the employer is going to pay the lender. This is a situation where the money is going to be pulled out of the consumer's bank, and the employer may know nothing about it. There's this idea that somehow this is free money. These are not charitable organizations. First, they ask for a tip. Now, a tip is usually something you give to someone who brings you food at a restaurant. A tip is not what you give Jamie Dimon for providing financial services. This is not a tip in the sense that you're providing it to a low-paid employee. You are paying this to the company. Second, you may think this is a voluntary tip, but instead it's built into the software where 2 or 3 times you have to delete it, otherwise it's self-populated and it's already in the system. But second, this is not free money because most people who do this
want the money now, need the money now, and if you want to get the money now, you have to pay interest to get it. They call that a lightning fee. So, you're paying a company to borrow money. It's not a tip. You're getting your money now. You're paying interest on your money now. You end up with less money than you would have gotten otherwise in order to get the money sooner. Are there practical reasons why that might be in the meet the consumer's needs? Yes, you may have an automobile that needs its transmission fixed. But is there any reason for us to say that isn't a loan? That it isn't subject to the same rules as other payday lenders? There's no reason at all. This is functionally identical to and directly competes against and is an alternative to the payday lending that we're already familiar with. And to just put another name on it and to say you're not borrowing until payday, you're transferring your pay makes absolutely no sense from the consumer's perspective. Either way, it's you get money now and they kind of take it out of your wages on payday. This is a payday loan in every sense. So let's expose it to the same rules as payday lending, and let us not pretend that a fee that's built into the software is a tip and that a lightning fee is voluntary when in fact that's what you're paying to get your money now. So I don't know why some technical dancing on a head of a pin argument should stand in the way of us realizing that a payday loan is a payday advance, is a whatever you want to call it, earned wage access, consumer protection, whatever you call it. It ought to be subject to the same rules, and I yield back.
The gentleman.
So I will yield in the interest of time, unless there's any other member. The gentleman from California, for what reason does he?
I want to strike the last.
Gentleman strikes the last word.
I
Gentleman's
want to
recognized.
thank all my friends on the other side of the aisle for illustrating the difference between the Democratic and Republican parties. The acting chair says that this is a highly competitive market, that people change from one bank to the other, and he may be true. So this rule only applies to institutions over, I believe, $100 billion. I believe there's a cutoff. I forget exactly where that cutoff is. So what this means is that those institutions will be free to keep their existing system, and they will attract all those pay-on-time wonderful customers, and they'll still get the great deal. And those who occasionally pay late can stay where they are and get the lower late fee. If it is correct that this is a competitive market, then some will be in one category, some will be in the other, and consumers can choose. Second, the gentleman from Kentucky says they should be able to charge their costs. I agree. That's why $8 late fee covers the cost. But it's not just $8. It's interest at a very high interest rate from the moment you pay late until you finally pay. Now, today's computerized systems, I wonder if there's even an $8 cost. This is not a situation where it's the 1970s and three bank officials need to get together and say, what do we do with Mr. Jones's credit card? He's over, should we cut his? No, this is all done by computer instantaneously at no cost. The report cited by the gentleman from Kentucky says, well, this could conceivably, I could grow hair. It could happen. But it's highly unlikely for the very reason that this is a competitive market. I cannot believe that this is going to come out of the hides of those highly prized credit card customers that pay on time and that are good credit risks. Those folks will still be able to find a bank that will give them a good rate. And to think that, but if indeed it is true that cutting these late fees is harmful to those good consumers, then why does the gentleman from Kentucky wax poetically in favor of those banks that waive late fees? Presumably, waiving a late fee is a stab in the heart of every pay-on-time customer the bank has. No, banks often waive late fees, and I've never seen that condemned by any member of this committee. When a bank waives a late fee, it is not stabbing its other customers. When you pay late, $8 charge, interest rate running at around 30%, that is plenty. And for us to say that banks should be free to charge 4 times their actual cost, $32 or more, on the theory that they're then going to provide a better deal for their other customers? I don't think so. Keep in mind, the banking system is already taking 3% or more from the merchant before they even make a penny off their customer. Do we really need to say that 3% on what is now increasingly every transaction? It's been a long time since I've used cash for anything other than our own cloakroom. So they're making the 3% on the front end. They're getting the late fees that more than cover their actual costs. And they're getting 25 to 30% interest every day that money's outstanding per annum interest. I can't imagine that the banks need more. But if they do, well, that illustrates the difference between our two parties. And I'll yield to the ranking member for any comment.
Thank you.